Obviously, over the last month or so, our focus has been on the various bits and pieces from the budget. And one area which is certainly deserving of consideration, and Amy actually wrote an article on this on AccountingWEB and got an awful lot of comments on it, Amy. And we were worried about maybe paying tax quarterly because of MTD and things like that. But in actual fact, we shouldn't be worried about paying quarterly. We should be worried about paying monthly or even weekly.
Yeah, so this is an interesting one because it did seem to slip under most people's radars, but it's quite a significant change for a lot of people. So the measure that was hidden, shall we say, buried in the Red Book, is that for taxpayers who are in both self-assessment and PAYE, they will, instead of paying the payments on account, so the January and the July self-assessment payments on accounts, a lot of them will be brought their self-assessment income will be brought into PAYE. So the idea will be that they will pay whatever self-assessment income tax they have when they pay their income tax on their payslip.
Of course, this has always been something that happened, but normally much lower levels, up to £1,000, £2,000, where we would say, please adjust through our tax code, please take the money that way. This is a much bigger issue than that, potentially with the amounts being taken.
It could be, yes. It's particularly for taxpayers who might have mainly self-employment income, but a small amount of PAYE income, such as a pension. For those taxpayers, we'll be looking very closely at the 50% rule, which will suddenly become a lot more interesting. And that's the rule that the amount that's taken for income tax via the tax code, via PAYE, can't exceed 50% of that taxpayer's taxable income for that pay period.
And of course, the 50% rule presents a problem in a way, which is that it's the worst of both worlds. They're going to collect the money through your tax code, but they can't collect what the tax code has said they should collect because they can only take 50%, which will then mean there's still more tax to pay later on, and that will then have to be done through self-assessment. So it's kind of a double kick in the teeth that it isn't really going to work. Obviously, you've written this article on AccountingWEB about this, and we had, at the time of recording, we've had a lot of replies to that article. People really are keen to comment.
I think one of the main concerns coming through from practitioners, taxpayers, the wider community, is that this will impact taxpayers who don't fit the exact mold of very evenly spread income across the year, of a significant enough amount of PAYE income that the full regular estimated amount of self-assessment tax can also be deducted from the payslip. It doesn't factor in those with seasonal or lumpy or transactional based income who might have a significant amount of self-assessment income in 1 month, and then their tax code ends up changing so that they're paying a hefty amount of tax every single pay period when actually their income significantly reduces in other months. And the main concern really is that faith in the tax code system and experiences of HMRC getting the tax code wrong is not really in favour of this new measure.
And yet the revenue are arguing on this, that this is required because so many people get to January, get to July, and haven't been putting money to one side, haven't saved up for their tax bill, and therefore can't actually afford to pay it. Their defence is that this will ease that out through the year.
This is the thing, yeah, and it is true that as much as we as accountants can say to our clients, you must put away 40%, whatever percentage it might be, of your self-assessment or self-employment income every month or every quarter and save it up for those January and July payments, with the best will in the world, a lot of people just don't do it. And you do end up in a position where payments are missed. Taxpayers are then subject to hefty amounts of interest on the missed tax payments. And so the revenues argument is that this is a way of helping taxpayers, helping their customers to meet their tax liabilities in a more regular and less risky, I suppose, manner. And they have actually said the taxpayers won't end up paying more tax under this new measure, just more frequently and earlier.
And as we touched on before, the nervousness with MTD was that suddenly the revenue would be saying we need you to pay 4 times a year, but would be paying in live time 4 times a year. It'd be the tax from that month would be due immediately. There's no suggestion here that that's what they're looking at. It would be effectively more payments on account. It would be last year's tax bill spread over a number of months, not live tax.
Yeah, it's impossible not to make the link between making tax digital and this new measure, despite the fact that the revenue have come out and categorically said that there is no link between the two. A lot of people were suggesting maybe the payment on account could have been made quarterly instead of biannually. And people are also suggesting that maybe further down the line, payments under MTD will be quarterly. The important thing to remember here is that the payment of tax will still be based on last year. It's not a move to a live payment of tax, as people are expecting to maybe see somewhere down the line under MTD. This will still be a payment on account, technically, just moving to a monthly or however frequent the pay period is, rather than twice per year.
And one of the groups who'd be really adversely affected here, of course, would be the low salary, high dividend people. And the problem, of course, immediately is if your salary is only £6,000, the most they can take when trying to take the dividend tax would be the £3,000 from that £6,000. So that's not going to be that helpful actually as in terms of collection. But this is on top of all of the other issues with dividend versus salary that, of course, have cropped up since the budget.
As you say, Giles, this is a conversation that's come up anyway as a result of changes to the dividend tax rate announced in the budget. So a lot of directors are looking at their salary versus dividend calculations and deciding in many cases that the dividend option is just not worth it anymore, and actually better to just take it all as a salary. And another factor in that decision will now be looking at this change to the way the tax is collected. At the moment, the tax on the dividend will go on the self-assessment tax return and it will be collected in January. So the director's got a year and a half to pay the tax on the dividend. From a cash flow perspective, if that tax is now going to be collected with the tax on the salary via the pay slip, then that cash flow advantage is lost as well, and the dividend route is looking even less attractive.
Yeah, it's an important thing to consider. The last thing to talk about, I think, is obviously I'm more than happy to be involved in a conversation that says PAYE codes aren't perfect, PAYE codes don't work as well as perhaps they might. But it's worth pointing out that neither does the payment on account system work perfectly. And actually we were just talking off air that this is a perfect example this January coming up of where people have paid, potentially quite different figures from those that they should have done.
Well, exactly, Giles. So because of basis period reform, 24-25 was the transitional year, and that's led to people's payments on account being wildly skewed for various reasons. Either if they had a long period to the end of the tax year to align their year end with April 5th. Under basis period reform, they'll have additional profits. If those additional profits were wiped out and more by overlap relief, they might have significantly less tax to pay because of basis period reform. And if they've managed to, or they've opted to spread the additional profits from the transitional year over up to 5 years, then again, that could reduce the amount of tax that they've had to pay for 24-25. So that's just an example of where the payment on account system, which estimates your tax for the next year based on your tax return for the current year, is not perfect. As you say, it can lead to people paying too little tax, people paying too much tax. And yes, of course, there is the option to apply to reduce your payment on account for the next year. So if, for example, your transitional year was a long period, so you had extra tax to pay for 24-25, you could apply to reduce your payments on account for 25-26, but that's a risk. It is a risky game because if you do reduce your payments on account and then you end up earning more than you expected, you're charged interest by HMRC on the whole year on the tax that you didn't pay. So it's not enough to just say, oh, the payments on account system is working fine. Let's just add in a couple of extra touch points per year. Job done. It's actually not that clear cut.
Of course, at this point in the year, there's perhaps more pressing needs in terms of our various tax due and all that sort of thing. So perhaps something for later on. And also worth pointing out, we don't actually have a specific date on this yet. We just know there's going to be consultation imminently.
Yeah, so the consultation will be open in 2026, and a lot of key figures from the industry have already said that they are keen to contribute. There will be lots of things to consider under that consultation. What to do with those lumpy or seasonal profits, fairness across taxpayers. The taxpayers charter has been mentioned in the comments on my article in terms of collecting tax fairly. Those taxpayers with a small amount, maybe even a minuscule sliver of PAYE income, will suddenly be paying tax far sooner than their neighbour with just self-assessment income. So that's another issue that will be discussed, I'm sure, in the consultation, as well as the mechanics of how it will actually play out. So we don't know when we can expect to see this come in, but certainly not before the end of 2026.
Amy, as ever, thank you very much.